And now we're turning to the very last panel of today's conference, which is going to be moderated by Theodore Economou. Theodore actually is the co-organizer of the conference. So Theodore, thank you very much for your valuable contributions. And Theodore has a vast experience in the industry. He's well known internationally. He's serving in various boards, and he has served as the Chief Investment Officer of Lombard Odier Investments. He has been the CEO of CERN Pension Fund, where he developed a very famous risk system. He's also serving in the investment committee of the Virginia Retirement System. And Theodore also has an excellent academic background. He's holding an MBA from Northwestern University and a degree from IFFR from Lausanne. So Theodore, as always, it's a great pleasure collaborating with you, and the screen now is yours.
George, thank you very much for this introduction. It would make my mom proud. I want to thank our prior speakers, Elizabeth, Jaap, and Mirko for their insights. And it's now my honor to welcome a truly global and impressive panel, as global as impressive, and to moderate their input, which I'm very excited to hear. So let me start in alphabetical order by welcoming from Athens, Panagiotis Andronopoulos, Vice Chairman and CEO of Alpha Asset Management since 2002. Alpha Asset Management is the largest asset management in Greece. And Panagiotis, importantly, before that, for 7 years, was Chief Investment Officer and a member of the Board of Directors. And he consistently ranked among the first, he consistently ranked first among all Greek fund managers in the Extel survey. And of course, that proved that his firm, Alpha Asset Management, is rightly named. And this contributed to becoming the largest asset manager in Greece. So I'm very excited to Panagiotis' perspective as a top performing manager, informed by 3 decades of experience in the industry, and his MBA in finance from City University and a BSc in mathematics from Patras University. Welcome, Panagiotis. Moving on now to the US on the East Coast, joining us from Virginia is Ron Schmitz, who until a couple of weeks ago was the Chief Investment Officer of Virginia Retirement System, the state pension fund of Virginia. He managed and oversaw more than 100 billion in fund assets, serving 800,000 active members, retirees, and beneficiaries. And during his 11-year tenure there, Ron saw the fund assets increase from 50 billion to more than 100 billion, an impressive performance. Ron has a long career in public pension funds in the US, including the State of Oregon Pension Fund, the State of Illinois Pension Fund, and he also, before that, had a career in the private sector. So I'm excited that we'll share Ron's perspective from his perch running one of the largest public pension funds in the US. Welcome, Ron. Moving now to the other side of the Atlantic, to London. It's my pleasure to welcome Carolyn Schuster-Walden. Carolyn is a managing director at Reddington, very well known in the UK as the premier investment consultancy dedicated to investment excellence, but importantly, and that's very relevant these days, grounded in social purpose. Reddington, of course, covers a full range of advice, research, and technology to some of the largest institutional investors in the UK, Europe, and China. Carolyn, from the top of her 20 years of industry experience advising some of the largest UK pension schemes. I have the pleasure to collaborate with her on one of them. And she contributes on all aspects of investment, including strategy implementation and sustainable investment alignment. And she's also an actuary, which is a rare quality to combine the actuary with the investment side. So welcome, Carolyn. I look forward to the UK perspective that you will bring to this panel. Also in London, Nikos Tessaromatis, Professor of Finance. I'm really delighted that Nikos is joining us because he's very much embodies what this conference is about, which is what? Bringing together pension fund investment professionals and academics, as Bill Kelly said in his introduction. Nikos is a bona fides academic, professor of finance at EDEC Business School, director of the PhD in Finance program and the Master of Science Risk program, but he's also an active investment professional. He chairs the board of TECA, the newly formed governmental GC pension fund in Greece. And before that, he had senior positions in asset management in London and in Athens. He was CEO of EDEC Asset Management, the leading fiduciary manager of Greek pension funds. And he had senior positions at Gardmore and Hermes. He has a very broad background. His research focuses on pension fund asset liability management, global investment strategies, fund manager selection, and risk management. And I very much look forward to Nikos's insights in all these fields. Welcome, Nikos. And finally, joining us from Montreal, Canada, is Mario Terrien. Mario is Senior Vice President and Head of Investment Funds and External Management at Caisse de dépôt et placement du Québec, in a way the State Pension Fund of Quebec. He leads there a group that is responsible for 60 billion, more than 60 billion in external investments as part of the 360 billion that CDPQ manages. His team leads and invests in private investment funds, in credit, in private markets, as well as venture capital in Quebec and internationally. And what's important, talking about governance, is that his mandate extends to improving in-house management through the sharing of knowledge and expertise that he obviously acquired, and his teams acquired through external contacts. He sits on the investment green committee and contributes his 30 years of industry experience. Very importantly, Mario also served as chairman of the Standard Boards for Alternative Investments, which is a leading organization bringing best practice standards worldwide for alternative investments. So welcome, Mario. And let me move right on, if I can ask everybody to turn on their, all the panel members to turn on their videos. Let me move right on. We heard from several of members, from our prior speakers, that things are different now. I quote Maria Vassalou, we now have to look at how we manage portfolio differently since the pandemic. With that, I'd like to turn to you, Nikos. Do you believe that things are really different? Where do you stand as an academic and as a practitioner?
Right. Well, thank you, Theodore. Just to correct you, I'm speaking from Nice, which is a much better place to be than London. And it's good also that you mentioned my academic side, because my position will be more strategic than tactical. So I make that clear right from the beginning. In situations like this, I always remember they say that the legendary investor John Templeton said that this time is different are the four most expensive words in the English language. Of course, one is also reminded that this time is the same, might be as expensive. So I'm very cautious of that. Right. So what happened in 2022 that started this kind of discussion? Last year, we had major big falls in both equities and bonds. Both delivered negative returns. As a result, a lot of people questioned whether the traditional benchmark, like the 60-40 benchmark that a lot of people use to compare their performance, whether that is relevant going forward. Okay, so in my mind, last year's events raise three questions. One is, how likely is that will repeat? Maybe in 2023 or sometime in the near future. Number two question, are we now in a new regime where we have inflation that is higher than before, and where the correlation between equities and bonds, which is the backbone of the 60-40 portfolio, the benchmark portfolio, whether that portfolio is dead, whether the correlations have changed, and therefore it renders that portfolio going forward in the future as not a good benchmark to have. And then the third question, of course, is that if we are in this new regime, how should we invest? Okay, I'll try to answer the first two questions. I'll leave the third one if there is a discussion later on. What's the chance of repeating the 2022 situation? Well, now this is my academic side taking over. I look at the evidence. I look at what happened in the past. So over the last 100 years, we had 4 occasions where we had both bonds and equities doing badly. One was in 31, 41, 69, 70, and then the latest one was last year. Of those, the 69, 70 is maybe the more relevant one, because it was a time of lax monetary policy where there was a fiscal stimulus at the time. It was also an energy disruption, much like it happened last year. That was followed by 10 years of inflation. The 70s was a terrible period. And the question is whether that's where we're moving to, okay? Now, statistics from that point of view suggest that this is a very unlikely event, and therefore we should not expect this kind of thing happening anytime soon with high probability. So it's still possible, but the probability of this happening is pretty low. What about the new regime, inflation and the correlation? On inflation, and I know that this is controversial because people argue both ways. I would argue that the peak has passed now. We are in a trajectory of falling inflation. Long-term expectations embedded in index-linked bonds suggest that maybe inflation is around 2%, hovers around there. So many forecasters think that inflation will be tamed at the end, perhaps with much higher volatility than before. What about the correlation between equities and bonds? And I'm close to finishing here. Is it now positive? And should we care about that? I mean, that's the question that I think is relevant to many investors. The justification from moving into positive is this: to combat inflation, central banks raised interest rates, which caused a slowdown in the economy. That, coupled with high inflation, meant that we had bad times for both equities and bonds, hence the negative correlation that we're seeing. If monetary authorities are successful in taming inflation in the near future, then there is a high likelihood, it is probable, that we might get back into this negative correlation environment pretty soon, okay? If that is the mechanism. Should we care? Well, again, this negative correlation is only over the last 20 years that we had that consistently. If you go back again, and I look at history going back to 80s, 70s, if you believe this, there are periods of positive and negative correlation. In fact, the positive correlation periods are more than the negative correlation ones. And of course, we know that over that period, this portfolio, the 60-40 portfolio, performed very, very well. So it has been pretty robust to that. And therefore, based on that, I am not worried, and I am more confident that going forward, the 60-40 one is a reasonable benchmark to serve as a benchmark to many investors.
Nikos, thank you. A very, I guess, reassuring message, you know, from an academic perspective, which goes more in the direction that things really aren't that different. Now, I'd like to turn to Panagiotis. Panagiotis, from your position in the first lines of asset management, the top-ranking performer, would you agree or not? What's your view?
Thank you, Theodore. Good afternoon, everyone. It is a great pleasure to be in this panel and have the opportunity to express my views. I will not touch upon so much on the 60-40 allocation that Mr. Tesaroumatis mentioned. So I will try to complement this question. So going through my third decade in the investment world, I have seen several economic cycles, bubbles, and crashes. But I think that now we may be experiencing a major change, reversing much of what prevailed in the last 40 years. Inflation is currently the elephant in the room. The advent of inflation since early 2021, causing the unwind of dislocations that Mr. Tesaroumatis also mentioned, notably negative policy rates and large central bank balance sheets, ended a 4-decade period of largely stable economic growth, low inflation, and incredible market performance. This had been a frustrating period for lenders and bargain hunters, while mainly favored asset owners and borrowers. A new regime of greater macro and market volatility is already playing out, according to my opinion. 2022 will be remembered as a dismal year for investment strategies across asset classes. As Mr. Tessaroumatis said, both equities and fixed income markets had double-digit drops, and we had this phenomenon of positive correlation breaking down a cornerstone for portfolio construction, at least in the last 20 years. Defined benefit schemes have benefited as policy and discount rates have increased, improving funding ratios, unless, of course, pension and liabilities are adjusted according to inflation, offsetting this higher rate benefit. Defined contribution pensions, on the other hand, have had to absorb all the pain from the declining markets, with those pensioners close to retirement and invested more in safer bonds, taking a disproportionate hit. I think these performance patterns are likely to continue this year as well. Inflation and real rates will be the key themes into 2023. A recession is widely expected as central banks are on course to over-tighten policy, seeking to tame inflation. Although inflation is receding from its recent peak, as also Mr. Tessaroumatis said, there are a number of underlying factors, such as aging workforces, geopolitical fragmentation, and green transition, that may hold inflation higher for longer. New reality of persistent inflation, higher yields, and real rates would mean that investors don't have to go for riskier investments to enhance returns as we used to do in the last 2 decades. It seems that the world of easy policy and abundant liquidity is replaced by a world where capital is scarcer, fundamentals matter more, and dispersion of returns is wider. I believe that the new regime requires a new investment playbook, as investment strategies that worked best in the past may not be the ones that outperform going forward. The new playbook should involve, first, more active investing, taking more granular views by focusing on sectors, regions, and sub-asset classes in order to capture opportunities arising from this greater dispersion and volatility anticipated in coming years.
Panagiotis, let me interrupt you. We'll go in more detail into the new playbook, but what I'd like to focus on for the time being before we go into that is we have two very different views from Nikos. Take a long-term perspective, things are getting back to normal, whatever that is. Then we're hearing from you in the first lines in the markets. Actually things are different, and we'll have to take this into account.
Are they really so different?
Excuse me?
Are they really so different?
Well, that's my question. I'd like to turn to Caroline. Caroline, when you hear it, you probably hear such kind of controversial, such different views when you talk to different clients. Can we reconcile this? What is a CIO to think? What do you tell your clients?
So I think, Theodore, can you hear me? Have I frozen? I think where we are is quite different. So I'm coming from a UK DB pension scheme background, and if I think about the journey that pension schemes have been on over the last 20 years, I'd argue that what we're looking at is a very different problem to solve than we had 20 years ago. So both of my colleagues on the panel have talked about, we've had rising interest rates, we've seen falls in equities and bonds, and effectively what that has meant is when you've got UK pension schemes, the actual size of the overall assets has fallen as both equities and bonds have fallen. Those have got illiquid or private market assets will have seen that proportion increase in terms of their overall asset strategy. And we've gone from a world where we're trying to build up assets to meet pension liabilities to a world where potentially, especially in the UK, where you have most schemes that are closed to new entrants and a much more mature market, making sure there's much more of a focus on having the cash to pay those benefits as they fall due, which is a challenge when you've seen the asset values fall quite significantly as you did. And in the UK, we had the additional challenge of I don't know what we call it, but the mini budget and the gilt crisis in September, leading to quite significant changes in asset values for pension schemes as they sold liquid assets in order to meet collateral calls for LDI portfolios. So you've seen funding levels sort of pretty much hold up, but underneath the bonnet, when you look there, the actual underlying asset allocation is quite different, and therefore the problem that you have to solve going forward is different as well. So taking both sides, is it the same or is it different? Well, I think we're trying to look at different issues now than potentially we were 20 years ago.
Thank you. So you're focusing really on the implications, Caroline. What your message to us as CIOs, as responsible for asset management for pension funds, you say, take into account what is happening, but focus really on the implications, right? Ask what should you do about it. Let me turn to Ron with that same question. What should you do about it? Ron, you had a winning formula over 10 years. You delivered superior value at Virginia Retirement System. What would you change? Jumping on Caroline's advice, do we have a different problem to solve in terms of the implications, and what would you change?
There we go. Yeah, it's an interesting question. I think what you do going forward depends a lot on where you are, which depends on where you're coming from. And I think the thing that worked out really well for Virginia in the past, coming out of the financial crisis, was more than doubling private market exposure and cutting our fixed income exposure by more than half compared to what it was 15 years ago or so. So now we're in a little bit of a different environment. Of course, rates are we're not in the lower for longer, but maybe we're in the higher for longer. Whether inflation's tamed near term or not, I think we're in for a more normal interest rate environment. So it's not the 70s, 80s rising rates, and it's not the post GFC declining rates. So I agree with the comment by the one gentleman that said fixed income returns are now more attractive than they have been in a long time. I think that's certainly true. I'm not so sure real returns will be more attractive in fixed income, but I think the big question for us is for Virginia, and when I speak looking backwards, I'm kind of speaking factually. When I speak going forward, I'm not speaking for Virginia, just to be clear, since I'm not the CIO anymore. They're actually doing an asset liability study, or starting the process of one now, with the new CIO and a new board chair that coincidentally was named second half of last year. But I think the big question will be, do we continue to have 50% of the portfolio in private assets? And I think there's a pretty strong desire to increase fixed income. And now that there is an income component to bonds, unlike many of the recent years, the question is where can we, near term, where can we get money to put into bonds? Because the liquidating or lightening up on private markets is not a short-term fix. So I think that's the real struggle that Virginia is going to be facing, and there are a number of ways you can go about trying to answer that question, I think. But I do think a focus on risk premia, and I think there'll be more varied risk premia now than there was before. 60-40 in the US anyway. 60-40 was often taken to be the S&P 500 for the equity side versus the Bloomberg Ag. I think the dominance of the S&P over public and private asset classes, public asset classes in other regions, and even over a lot of private asset classes, is not likely to persist going forward. And so that could be a source of some funds to increase fixed income exposure. So let me stop there. If you want to drill down a little more or want me to drill down a little more, I'd be happy to, but might be a good time to pause.
Thank you, Ron. Let me turn to Mario. Mario, you just listened to Ron's views, running a very large global level pension fund. What do you make of Ron's views? Do you agree? And what do you tell your allocators at CDPQ?
Yeah, well, first of all, Theodore, thank you very much for the invitation. I'm very happy to be amongst you guys today. Always good to share knowledge, expertise, insights with such a great crowd. So what can I add so far? I mean, lots of very interesting views around the table. I would say if I would bring something different, additive here is I think one thing for sure. Let's say we're in a bit of a new paradigm, and we could argue what this new paradigm is, but clearly this is something different that we've seen in the last 30 years. And I agree, by the way, the 60-40 went through a real stress test next year, and it'd be it would be really bad if we were to go through another 2023 with such bad performance. That would be like a real, more than 3 sigma event. That being said, one thing that comes to mind today is when I look at my last 25, 30 years, a lot of the money that's managed by the big allocators have been moved from desks to committees. So we need to be mindful of that, because as we are discussing these changes in asset allocation and things like that, it's a different story today to convince and influence and socialize big committees around sort of a consensus around what should be the right asset allocation. I mean, it's complicated enough. So that's one thing that comes to mind. I sit on the big investment committee at CDPQ, and we have a lot of dynamic dialogues, but clearly that is something that making sure that we're all aligned with that view and kind of build it together. I would say in the last 10, 15 years at CDPQ, before I go there, I also noticed especially in the last 15 years, this low yield, low return, kind of a nice and friendly environment where markets were going up. And if they're not going up, somebody would make sure that they go up. I noticed that there is this behavioral convexity that's been developed, where the lower the rates would go down, the more risks allocators would take. And that risk was toward risky asset, whether it's private equity or public equities, but also in different alternatives. So I would imagine that if we are in something that's much different, just the technical unwinding of this, as we're all going to be sitting in these committees in the first 3 years after our 31st results, the technical flow that this will bring will actually probably brings more volatility to markets, to be quite frank. I mean, just as an anecdote, I was saying to my wife recently, it's the first time I've been able to buy Canadian 3-month T-bills yielding 4.5%. And I didn't remember the last time I could buy them because my broker's account did not have enough history. So it just shows you how the mindset will be changing, and that's something to be mindful of. To Ron's point, I agree. I mean, we've had this big shift over the last 12 years, just the shifting from public to private alts. So this is infrastructure, real estate, private debt, private credit has been a big beneficiary of this. And we can discuss more later as to how this might be able to navigate a little better going forward versus corporate credit, for example. That's something that we've done quite a bit. And, not necessarily thinking about inflation, but having in the back of our mind that if there was to be inflation, that would happen. And the other big shift we've done since 2008-9 is back in the days, 2/3 of our portfolio was in Canada. And now only 1/3 of our portfolio is in Canada nowadays, and with a much bigger absolute assets under management. So we've made a lot of these changes, diversification and everything. And I'll be happy to jump in more details as you wish, Theodore.
Thank you, Mario. We heard a lot of themes here: higher volatility, more attractive fixed income, perhaps a decade of actually declining allocations to private assets rather than increasing allocations to private assets. Caroline, how do you put all this together? You have a very broad range of pension funds that you talk to. Are you seeing similar trends emerging? What are the priorities? What are your priorities?
Yeah, very, very similar, Theodore. I'm just picking up on some of the comments so far. And I don't remember who said it, but talking the difference between defined benefit and defined contribution schemes as well, and the impact that it's actually had on members. Because I think on the defined benefit side, you've typically got the older population who are drawing their benefits. Their schemes are fairly well funded. It's about managing those cash flows down. On the defined contribution side, you've potentially got members exposed to risks that they weren't expected to be exposed to. So, for example, on as they're close to retirement, holding government bonds, and we also in the UK and across the world, what happened to those last year, and actually having that communication to members when they weren't thinking about having fund values that could potentially fall by as much as we've seen. And I think one thing that's going to be interesting, and I think it's still very much in its infancy, but if you've got big DB schemes that are trying to sell some of their illiquid markets, whether it's the private credit, whether it's property, whether it's infrastructure, and we haven't yet even talked about sustainable investment, and we've got got half an hour through, but effectively how those would cross across to DC investors, because the regulatory framework in the UK is not such that you can do that very easily, given that the platforms and the frameworks that you need around that. But you can see that if there's potentially a shift, and you've got large defined benefit schemes trying to sell these assets, and you've got younger members potentially looking for growth, looking for more stable assets, you could see a sort of a switch across to there. So I think that's going to be an interesting theme as we look forward over the next 5-10 years as well.
Thank you, Caroline. I think we have gotten a pretty good high-level perspective here. I'd love to drill down now a little bit more specifically into specific asset classes, and I'll pick some examples. I interrupted you before, Panagiotis. You are about to give us some very specific themes in terms of market leadership changes you could do. You want to give us your top priority in terms of what you would do, more specifically by in asset classes.
I was trying to be a bit additive as well, and complementing to this discussion about 60-40, which is very, very trendy since last year. What I was telling is that I anticipate that asset markets are going to be driven less by central bank support, which had been a headwind for alpha generation. That's why I raised the issue of more active investing in this new investment playbook. Also, I think another issue is that there should be increased asset allocation and risk budgeting flexibility, as this positive correlation, which I think is here to stay, between the returns of stocks and bonds, means it will take higher portfolio volatility in achieving similar levels of return as before. I am also positive for the private markets. I see opportunities in infrastructure because I perceive it as inflation protection, diversification, and a way for alpha generation, as there will be increased demand for capital over the long term. To address these secular themes I referred before, those of energy transition, digitalization, and this globalization transformation. Of course, as it was mentioned before, it's it's a matter also of the starting point. If you are heavily invested in the private markets already, you may have a different perspective.
Very helpful, Panayotis. I'm going to pick up some points that caught my attention. The first one, you said more active management. I'd like to turn to Ron here and associate that with another point you made, Panayotis, which is less central bank support. Ron, we've had the US markets lead the world markets the last literally 10 years. In large part, this has been attributed, exposed to central bank support, Fed support. Will this continue? Are we going to see a change of leadership? How do you see it from the US?
Keeping in mind that that my opinion on that plus $5 will buy you a cup of coffee at Starbucks. You know, I've actually thought for some time that the U.S. leadership was more from a valuation perspective, maybe than earnings growth perspective. But in the equity markets, U.S. leadership was a little over. You know, that there was a little bit of overvaluation, and that both non-U.S. and particularly emerging markets would be more attractive. And I've been dead wrong for 4 years on that opinion. But I do think going forward, that'll be more the case. You know, I think there's some other reasons behind it, structural. I think we talked a little bit in our pre-planning panel, but the U.S. has much larger technology exposure within its market than the rest of the world. I don't know that the boom, particularly the pandemic-driven boom in tech, will continue to quite the same extent that it had before. So I do think you know, that my own personal opinion, and whether that gets reflected in the Virginia's changing strategy as they do their asset liability study, I don't know. But my own opinion is that I would de-emphasize a little bit the U.S. and put more weight in non-U.S. markets in the public equities area. I agree with the previous gentleman that the private markets are still very attractive. And I think one of the things that kind of is often missed by folks, real estate, real assets, and private credit are really a shorter term, even though the fund terms may be the same 10 years as private equity. As a practical matter, the drawdown periods tend to be a little faster, but more importantly, the harvest periods are shorter. And so there's actually more churning, if you will. That's the wrong word to use, but I think there's more liquidity in those private market sectors than is commonly thought. So I don't know that in our case, with half the portfolio in private markets, that you know, Virginia would need to run out and try to look at secondaries or just, you know, drastically cut its annual capital budget to private markets. I think the real question is if in the shorter term you want to increase fixed income exposure, you know, where's the money come from? And it's either equities or you put leverage on the portfolio at a top line level, which is not something very many funds have done in the U.S. One or two have, and I think that Virginia will explore that, making no predictions about whether they'll do it or not. I do agree that it's a time to be a lot more nimble. I think risk budgets, the absolute level of risk budget in an absolute sense, whether it's 12% annual volatility or 15 or whatever the number is, I don't know that necessarily has to be managed all that actively, but I think the sources of risk within your portfolio will need to be more actively managed. So I think the plus minus ranges of your target asset class exposures has to be broader, has to be wider than it was in the past, and you have to be more willing to actually utilize those ranges and not just hug the policy target level. And that's always that can be quite a challenge because it's very easy to be wrong and or you can be wrong short term before ultimately being right longer term, and just having the patience and the perseverance to stick with it can be kind of tough.
So I guess the secret here is not the concept of actually being more diversified, which is a theme I just heard from you, from Panos, from Caroline, but it's actually how do you do it, right? How do you manage that risk? How are you more nimble? I'm trying to pick up on the specific expressions that you used. Mario, can you at all be nimble? You're sitting on 360 billion. Can you be nimble? Can large pension funds be nimble at all? And how do you actually do it in reality? Mario, you're on mute.
Sorry. I think, we used to say, and we still say, I guess, that size is the enemy of performance. But when you're aware of that, you can actually, change that constant and make it more of a variable. So I think that, again, I go back to the governance. I think it's important to bring your stakeholders on board, the committees on board, and really adjust and make sure that that you're able to be more opportunistic. I mean, this environment is going to be more of a reflexive environment. It's going to be an environment that changes every 6 months. So you need to make sure that the investment teams have what it needs, the resource they need, and the proper capital to pounce on these opportunities. That being said, it doesn't mean you need to do like proper due diligence. If you're investing directly, you need to have a proper team. You can't be a tourist. I mean, this environment is an environment that I don't remember having lived for my whole career. I mean, it's an environment where the macroeconomics is converging with geopolitics, and most investors are not accustomed to that environment. So if you're a private equity guy, you do deals. If you're a stock picker, you buy companies. If you do private credit, you're very bottom up. So we have this different environment. So at the same time, the organization needs to make a switch to being a little more macro aware. And some people, always say that macro is not worth something. This is where I defer quite a bit, actually. So I think it's being aware of macro. It's bringing the governance on board, because committees again have a way of being a little too sticky and not necessarily aligning in the interest. So you need to work on this, I guess.
So you used the word I like. You said you have to be nimble and know what to pounce on. Let me go around. What do you pounce on, Mario? And let me turn to the others also. What should we pounce on? We just heard from Ron. Well, maybe it's not the time to pounce on the U.S. market because it's going to lose its leadership. What is happening at the confluence of geopolitics and economics? What's emerging? What should we pounce on?
What we've been doing a lot, I mean, from like smaller size, obviously, we like these reflexive strategies. So macro has always been a part of our portfolio. We have macro managers. And again, this is not an easy strategy. You don't want to be a macro tourist, that's for sure. So selection of good partners is important. Trend following is something that we've done quite a bit also, which is, we feel that in this reflexive, self-sustaining environment, trends will be more sticky, and which is very, very good. And these strategies are not agnostic to yesterday's information, and that I think that's really important. I mean, to the original question, I think one of the biggest mistakes that we can make is the peril of yesterday's logic. If we're too biased around yesterday's logic, it might be to our disadvantage in the future. So having this very open mind and working with such managers helped us quite a bit. Again, just going back to private credit, this is something that we've spent a lot of time on. We feel that private credit has been a very interesting strategy for us to craft a structure that is probably more resilient. And I'm not saying it's easy again, but if we were to have like a real recession, that asset class will go through issues. But that's for sure an environment where a strategy that probably has legs in front of us.
The perils of past thinking. I think this will be a wonderful motto to remember from that panel. Caroline, how do we avoid the perils of past thinking? What do we pounce on? What do you bounce
So
on?
I'm going to pick up a comment that Mario talked about in terms of governance, Theodore. So it's not a traditional asset allocation thing, but I think it's making sure that you've got the right people making the right decisions, and really you've got the structure to enable those decisions to be made at the right level. And you talked about being nimble. You don't want a trustee board where you've got 20 people around the table with different levels of knowledge making the decisions in terms of what the asset allocation should be. So I think it's about making sure you've got your governance right, making sure you've got the objectives for each of these committees right, so everyone knows what their role is in terms of managing the asset. So I'm sideswiping it a little bit, but I think governance is something that potentially, you know, in this ever-changing world, actually having that set up and focus on that is really important.
Terrific. So governance alpha, maybe we can call that, also echoing Elizabeth's comments. Nicholas, what do we pounce on to navigate that new world, or not?
Right.
Not that new.
Right. Well, I think the panel already talked about, thinking about illiquid alternatives. I'm not a great fan, to be fair, because there's already quite a lot in portfolios. And I'm always reminded that they share the same economic exposure like public markets and bonds. So I would be very hesitant to do this. I would pick up a point made by Mario earlier about macros and trend strategies. Perhaps some, not all investors would like to think about strategies that will give downside protection. I will include volatility strategies as well. So people should be, depending on who they are, how sensitive they are to downside risk, they should consider this, not everybody. The other area is, and I'm surprised to see little take up so far, and this is risk premia outside the traditional bond and equity risk premia, whether within asset categories, within equities, for example, or across. So I would expect to see more. I was looking at some statistics recently on the behavior of different asset classes and risk premia during different inflation regimes, and it's very clear that these kind of investments are not going to be affected by inflation. Despite what I said about inflation, I still think that a good investor should hold portfolios that are hedged against inflation, because even if you think inflation is coming down, it's not going to be a problem. There is so much uncertainty, and it will be, I think, it would be a good idea to look at asset classes like commodities, for example, infrastructure, index-linked bonds that will provide that kind of protection.
Thank you, Nikos. Let me move to Panagiotis. Panagiotis, you were the first one to put the word on the table in the panel, diversify among more risk premia. You've been a Euro investor mostly, as I understand it. Euro equities have lagged while US overperformed the past decade. What are we looking at? You argue about being more active. Does it mean being more active in geographies, being more active just at sector level? What do you want to advise us?
Since I expect greater dispersion and volatility, as I said, down the road, I believe applying the right balance between discipline and flexibility is critical. By flexibility, I mean provide the degrees of freedom to the portfolio management team to exploit these investment opportunities and potential market dislocations that I anticipate looking forward. When I say more active investing, coming to your question, I mean being fully granular, being fully on a bottom-up basis. So it's not just the geographies, but it's an approach based on security level. So
very good. Dislocations is a word that I keep in mind. Moving back to Ron. Ron, what about you? What can we do about U.S. market leadership not being there anymore and being nimble? You told us that private markets are not the solution. We might actually see a reduction. What should we do? What is your word of advice to close this panel?
Well, I don't know that I have anything new to say, being at the tail end of the question here as you've gone around the panel. But I agree with Mario. I think credit will be an ongoing, very robust area to invest. Pension funds and other sources of capital really stepped in post GFC because the banks and insurance companies and other intermediaries, were forced to kind of step out due to regulatory changes and so forth. So I see credit being a very attractive ongoing trend, despite all the money and all the interest that's been in it shorter term. I do agree that private equity is a little bit long in the tooth. Perhaps it's pricey, although in an environment while all asset classes were pricey, it wasn't so bad. But now I think they're on a relative basis. There could be other more attractive options. I think the thing that keeps coming back to me, the phrase, and I think you picked up on it and kind of refined it a little bit, but the macro alpha concept. I think I spent a lot of time in the last 6-7 years at Virginia trying to get the team to think more in macro terms, and it's kind of taken the form of, let's identify what the consensus view seems to be across asset classes, across the environment, macro environment, and then where does the house view differ, and are those differences enough, potentially attractive enough to trigger an asset allocation move. And it's been something that it's hard to get a team that's a little bit skeptical about macro or tactical shifts. It's been tough to get the team to kind of think in those terms, but I think we've made really good progress the last couple of years. The fund benefited quite a bit from being light equities, in 2022. And I think there's a little bit of a self-fulfilling, self-congratulatory aspect to that. So, a little bit of success emboldens some additional success. But I agree with several of the panelists. I think you really have to be more tactical and more nimble.
Well, thank you, Ron. A very good, motto to think about as we close this panel. I want to thank our panelists for contributing their perspective from very diverse perspective. We heard some issues where there was a fairly strong disagreement, but we also come out with some very good pieces of advice, practical as practitioners, to implement and informed by academic perspective. So thank you, Mario. Thank you, Caroline. Thank you, Nikos. Thank you, Panagiotis. Thank you, Ron. It's been a pleasure and an honor to allow to be part of this panel and moderating it. George, back to you.